My name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of LME 3-month nickel and zinc. I'll start with LME 3-month nickel. 8 weeks ago, we saw a drop caused by the significant resistance of the very shallow and old upper time of the 2017-2018 bearish shift pitchfork, currently at 20,270, along with the corralling effects of the September 2014 high at 19,935 and the June 2014 high at 20,000 even. All these capped the market's rise at the time, and their rejection of the bullish incentive caused a move lower that was only halted by the slowly rising long moving average below, currently at 16,125. Since then, the market has been framed in between the long moving average below and the middle time above, currently 16,775, of the same shallow bullish shift pitchfork. This back and forth action, running for 7 weeks now, is obviously indicative of overall indecision, not on an intraday scale but on an interday scale. Hence, I've recently looked at the drop from the high, and especially the drop from Wednesday, the 3rd of March, as a possible bear flag stroke halfway hesitation type action. As the long moving average support continued to look solid and the middle time overhead resistance as well, then that seemed to be the way. 2 weeks ago, we had the first key reversal up since the big drop. It was not immediately concerned, as we had a reactionary bearish engulfing pattern 2 days later. That kept the market within the middle time overhead and the long moving average below. Then this week happened, and we had some large periods of indecision. Tuesday last week, we had another key reversal down. This time it was more serious, as prices closed below both the lower time of the more recent October to 2020 to February 2021 bullish shift pitchfork and the long moving average, the first time for the latter since July 2020. This looked like might be the potential anticipated move lower. However, not so, as Wednesday was an immediate countering bullish double, followed Thursday by counter to the counter bearish double, and finally on Friday by a third countering key reversal up and bullish engulfing pattern, the latter pattern only just. As you can see from these contrary and countering patterns, this was a period not just of intraday indecision but interday indecision. The market was not happy about this choice of going lower. This was followed yesterday by a follow through higher, and today by a breach upwards over the middle time. Okay, so what is different about this breach higher than the failed one back in early April? Well, 3 things, not all of them actually bullish. The first is that the move below the lower time of the more recent bullish pitchfork and the long moving average was swiftly pulled back up, over and up, out of the lows. The speed of the recovery and the new move higher, the highest since early March, is indicative of some heavy support. We did not see this prior to the earlier breach. Secondly, the severe indecision last week. A market not knowing its mind and seemingly making a wrong choice lower, then correcting it rapidly. This was not there before. Finally, and a non-bullish one perhaps, it is the rapidly descending short-medium moving average from above, currently at 17,075, that may temper the bullish incentive we've recently seen. If, on the other hand, the market passes right through it, then it may be indicative of the strength of the underlying bullish sentiment. We shall see, probably in the next few days. Finally, if the market confirms this move higher, which it still has to do, then it puts pay to all the targets below for a possible bear flag stroke halfway hesitation type action. They are, for the move from the 3rd of March, target X in a preliminary move to the 15,335 area, with a full move at target X1 in the 13,675 area. For the full move from the late February action, a preliminary target X2 in the 14,770 area, and a full move down would be in the 12,445 area. I'll only remind you of my words from last week, and I quote, "My only concern, and this is the same one it has been for many weeks now, is that this thing has gone on way too long to be helpful. It may be that the long moving average is currently impenetrable, and we see prices turn back upwards, in which case I'll deal with that when it comes. It seems that I and others may be dealing with it, and soon." LME 3 months Zinc. I wrote back in November last year how the bullish incentive was still alive. This was due to the, and I quote, "shallower bullish shift pitchfork with the same move," and that's the early July to early October 2020 move. End of quote. I added also, and I quote, "So while superficially the market may be topping and looking sideways to a potential move lower, the reality is that the bullish incentive is still alive, though at a less acute angle. It all depends on what the market will do with the big old 50% Fibonacci line at 2806, because there's a lot of support below and also a little resistance above." End of quote. Since then, the market's first choice was to punch lower, actually exiting out of the bottom of the bullish shift pitchfork. However, there were mitigating circumstances. I wrote 14 weeks ago, at the end of my commentary, and I quote, "We seem very much to have formed a large rounded top with elements of a triple top within it. Potential for the triple top would be where target X is placed on the daily chart, at about 2578, end of quote. You see, target X is still on the chart. Target X was the reason the market exited the bullish shift pitchfork, and it was the only reason. As soon as target X was achieved, prices started moving right back up again, halting only just before the April 2019 high at 2958. Since then, prices have dropped, then held on a closing basis by both the short medium moving average, currently 2820, and the medium moving average, currently, where is that now? It's 2787. This is how we've ended up, back where we started, at the 50% Fibonacci line at 2806. Problem now is that time has moved on, and the lower time, currently 2875 of the original quote shallower bullish shift pitchfork that I mentioned earlier, has risen and been threatened once again. Only this time the market has seemingly understood this and moved higher, with a combined key reversal up and bullish engulfing pattern last Friday, and a bullish opening long white Mariposa yesterday, giving the highest high since late February, and interestingly, the highest close since April 2019. Now comes the however. Okay, however, we've had plenty of false breaks above 2900 in the past. Caution is advised even now. You see, there was a possibility that the action from October last year until early March might be a possible double top. That is something to consider. At the same time, the possible diamond pattern formed over January to March could see this current move up as a righteous move higher. I was ready to retire this pattern this week. I said so last week. But I've kept it on, as despite the delay, it may give a target to look to on the upside. So, just in case this is not a false break higher, and take into account the idea that the bullish incentive is still secure, I've placed a couple of possible targets topside. Target X in the 1395 area is a preliminary target for the misshapen diamond as a continuation pattern, whilst target X2 in the 3215 area is a full move higher from this same diamond, misshapen diamond pattern. Now this last one is interesting because it's coincident with the June 2018 high. It doesn't mean they will happen, it just means that if they start, you'll have an idea of the size of the possible move occurring. Thank you for listening. This weekly broadcast gives the essential patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.